Welcome to Talkpoint, your trusted source for verified, balanced, and independent reporting on the stories shaping America and the world. Are the shadows of 1929 returning? Some analysts are warning that the US economy may be hitting and turbulence under the Trump administration economic direction. But what does the data actually show? And is America truly on the brink of another crash? Let's take a closer look. As of late 2025, the US economy remains stable but is showing clear signs of slowing down. According to the US Bureau of Economic Analysis, growth in the third quarter fell to 1.6%, down from 2.4% earlier this year. Unemployment stands at 4.2%, still historical low, but job creation has been cooling for several months. Inflation meanwhile has leveled out of about 3.1%, slightly above the Federal Reserve 2% target. Interest rates remain high, between 5.25 and 5.5%, as the Fed continues its effort to curb inflation without triggering a recession. Mortgage rates have now climbed past 7%, putting significant strain on new home loans and slowing real activity. President Trump's second-term economic strategy, often referred to by his campaign as the America First Growth Plan, centers on a combination of tax cuts, expanded tariffs, and energy deregulation. His administration argues these policies are designed to boost U.S. manufacturing, lower dependence on foreign import, and increase job opportunities of American workers. However, leading financial institutions, including Moody, Analysts and Goldman Sachs, caution that these such measures could expand the federal deficit and raise prices over time. The national debt has already cost $36 trillion, and higher borrowing costs may make future repayment more difficult. Despite these worrying, the overall U.S. economy is far stronger today than it was in 1929, when the stock market collapse led to the Great Depression. Modern financial safeguards, including the Federal Reserve System, FDIC, deposit insurance, and international cooperation through institutions like the IMF and World Bank, make a full-scale economic collapse extremely unlikely. So why are some experts invoking the shadows of 1929? The answer lies in the market. The S&P 500 is currently trading at 25 times earning evolution. That hasn't been since the dot-com bubble. Household debt has claimed to over 100% of disposable income and wealth recently widened sharply. Economists point that these are risk factors but not red flags to imminent crisis. The Federal Reserve Chair Jerome Powell recently described the U.S. economy as strong but under pressure from high borrowing costs. He noted that the Fed's current goal is to achieve a soft landing, slowing inflation without stalling growth. International analysts, including those at the International Monetary Fund, focus U.S. growth to slow and around 1.7% in 2026, suggesting a period of moderation, not collapse. The IMF also warned that rising global trade tensions, particularly between the US and China, could create headwinds in the export-driven sector. At the same time, consumer spending, which makes to up to two-thirds of America's GDP, remains steady but cautious. Retail sales grew just 0.3% in the last month, while credit card delinquencies and have ticked slightly among your borrowers. The shifting indicated America has still spending but becoming more conservative in the financial habit. Meanwhile, Wall Street volatility returned with the Dow Jones and Nasdaq posting notable declines, and recent week analysts described this swing as correction rather than cautious initial response to tighter financial conditions and investor uncertainty. While the time shadows of 1929 captured public analysis, experts across Reuters, Bloomberg, and the Brookings Institution agree that the comparison of overstate. The U.S. economy today is highly diverse, technologically advanced, and supported by an adopted central bank. The challenges are recent boost, slower growth, and elevated rates, but the foundation remains strong. In short, America's economy is cooling, not collapsing. Most economistic experts mind shutdown and short-term recession, not a depression. The real sick, they say, Not is a financial collapse, but in policy missteps, its leaders fail to balance fiscal discipline with continued support for jobs and innovation. At Talkpoint, we will continue to monitor and data and bring you only verified fact-based update on the US and global economy, not spectral, no spin. Thanks for watching. If you found this report helpful, don't forget to like, share, and subscribe for more verified update on business and policy and the world affairs. Stay tuned and stay informed. Happy